All right, good morning, everyone, and thanks for joining us in our last panel of the day. Appreciate it. We're going to focus on shareholder democracy and the shifting center of ownership. There has been a ton of movement in this space, as all of you know, from how ownership is concentrated to the growth of the voice of the retail investor and the changing dynamics of proxy voting. The balance of influence among shareholders is evolving fast, and so are the tools, expectations, and responsibilities that come with it. So we've got a terrific panel today to help us make sense of what all this means for investors, for boards, and for companies as they look forward. So with that, let's dive in, and I'll have our panelists introduce themselves. Would you like to start, Kate?
Sure. Hi, I'm Kate Monahan. I'm a director of shareholder advocacy at Trillium Asset Management. We are a socially responsible registered investment advisor with $4.7 billion in assets under management. And since we were founded in the early 80s, we have sought to incorporate environmental and social and governance considerations into the investment process as a way to identify those companies that we see as best positioned to succeed in the long term. And we also feel that we have a responsibility as shareholders to engage the companies that we hold on environmental, social, and governance topics. Just thrilled to be here. Thank you so much.
John?
I'm John Galloway. I'm from Vanguard, and I represent our investment stewardship program and our investor choice program. Vanguard is a large asset manager, owns many U.S. portfolio companies and global equity holdings. Importantly, I represent the funds that are passive, our index funds. And that, what we can talk about this in terms of the kind of changing landscape. Vanguard in some ways epitomizes it because we have active funds that have always been managed differently from a voting perspective, at least for the last 6 years. And we're introducing our investor choice program, which passes through voting to the holders of mutual funds and ETFs.
Great, thanks, Krystal.
Great, Krystal Berrini. I'm a partner with PJT. I lead our shareholder advisory group, and that means that I work with a lot of public companies on advising them with investors such as Trillium and Vanguard, particularly navigating the tricky dynamic that we're in right now and that we're going to spend some time talking about.
Yumi.
Hi, I'm Yumi Narita. I'm the Executive Director of Corporate Governance for the New York City Pension Funds. I work for the Comptroller, who is an elected official of New York City, who was in the news quite recently for getting arrested. But my direct initiative and focus is to ensure that our pension fund trustees, support our advocacy work. And I'm happy to be here to discuss that.
Great. So we've got a lot of different perspectives represented, which I think will really inform the discussion today. Krystal, why don't we start, if we could just level set a little bit for the audience. What does shareholder democracy mean? Why does it matter today? How should they be thinking about that concept?
Yeah, of course. Always good to start with defining what we're talking about. Also, today, there might be different definitions, but I'll give you my, how I think about shareholder democracy. I think at the most basic level, we think about it in terms of a concept of shareholders having an influence and an ability to shape and guide the companies with which they're invested, right? It is the ability for owners to impact the companies that they're invested with. And now, what does that look like in practice? I think a lot of it is probably common sense in some respects, right? It's the rights that shareholders have at companies. So it's the ability for them to vote to elect the directors that represent them on the board. It is to help guide and shape and the ability to vote on major corporate decisions, M&A and the like. The ability to influence and vote on how a management team is incentivized and compensated for how it is they're going to be incentivized to drive the actions that investors are looking for them to take. Submitting or voting on shareholder proposals, right? It's all of the things that we talk about in terms of the shareholder rights and how investors participate in that process for the companies in which they're invested. Now, what I would preview is I think all of this is getting a little bit more complicated in the environment that we're in because of some of the dynamics that you're seeing play out within the investor community. You're seeing a lot more fragmentation, and I know we'll get to that in a minute, but I think it is all of these things that are impacting shareholder democracy and probably why we're all on this panel here today.
Yeah, I think it's helpful for you just up front to recap some of the key developments for the audience. And it's, I mean, frankly, if you aren't following it verbatim, you do miss things, right? So what's been going on in the space? What are some key themes that may actually affect shareholder democracy?
Yeah, of course. I had to write them down because there's so many of them. I wanted to make sure we hit them. But look, I actually think a lot of this has been in motion and in play for a while. But I would start with earlier this year. I think in build, even just what has transpired over this past year. Starting with some of the guidance that came out of the SEC around 13D and G, I think the definition of what it means to be an active investor versus a passive investor. At its most basic, that's a really important distinction, and it's really important to many investors who hold over 5%. And what we saw this spring was definitely a chilling of the engagement that I think a lot of investors and asset owners enjoyed at the companies that they were invested in, because everybody was working through it, right? Everybody was working through how to work in this new paradigm in which the definition around what defines a 13D and G is different. And now I think a lot has transpired over the course of the past now 6, almost 9 months probably, since all of that came out. But the way in which companies investors are operating in this new paradigm is different, right? It is impacting the likes of a Vanguard and a BlackRock and those who often hold well over 5% of companies, different than those investors who are typically well below the 5% mark, because it's just a different set of risks in the way that they can engage with their portfolio companies. We also saw a lot, just from a really basic standpoint, coming out of the SEC with how they thought about no action guidance on shareholder proposals. I think the stat is that the number of shareholder proposals, I think, was down like 30% of just those that actually made it to the ballot for the S&P 500. That's a major shift change just coming from the new paradigm that came out of the SEC early in the spring. And that's just again, as you think about like the rights, right? That's how the investors are participating from a democracy standpoint around engagement in shareholder proposals. There's also been BlackRock and Vanguard have either made or are about to make changes to their business to split up. And I'm not going to speak for John, he'll speak to it, but it's something that BlackRock did this year. There's now 2 different entities within BlackRock. Vanguard is going to be making this shift at the beginning of next year. There also has been the implementation of vote choice, right? For some of the investors who want to maintain vote control. And some of the stats, John will correct me if I'm wrong on this, but the ability for investors, the underlying asset owners, to participate in this, it's a really big pool of investors who can participate in it. I would quote about $3 trillion in AUM eligible to participate from Vanguard, 3.3 trillion for BlackRock. State Street is 1.9. That's a huge swath of assets that are able to participate in this. And so when you take a step back and just think about this, companies have already been navigating a fragmented shareholder base. No 2 shareholders often think alike. And now what this is doing is you'd have one shareholder that you think you understand really well, and that's being further fragmented, right? Whether that's splitting into multiple entities or whether the assets that are owned within that shareholder, are going to be voted or controlled or influenced by different constituencies within there. And so it's just this further fragmenting is kind of how I would categorize this in this investor piece. And I know we'll hear from John on this, but just kind of set the table of what companies are navigating from the fragmentation. The other recent development that we saw, Exxon announced the ability for retail voting program. And again, this goes into the bucket of further fragmentation, right? Who is actually influencing companies is becoming more fragmented and more fragmented. I think there's an expectation that we'll probably see some other companies do this in 2026. That's the rumor. We haven't seen any yet, but I know this is very costly and is not an easy endeavor to do this. So I think it remains to be seen just how much of this we see, and I think there's going to be a lot to learn from this Exxon example. But again, furthering of the complexity of the environment in which we're operating from a democracy standpoint. The other more recent news, the proxy advisors. So both ISS and Glass Lewis have announced that they're going to have options with their research to produce research without a recommendation, right? And so investors could subscribe to research where they get all of the research, but don't actually use or don't actually get even the recommendation. So living in a world in which there is now just more options, actually companies will probably have less line of sight what even an ISS or Glass Lewis might be suggesting to their investor bases as they put out their research. There's also been even more of a push around custom policies. Custom policies have always have been a meaningful part of how the proxy advisors work with investors, but I think that we're seeing an even greater push towards custom policies. And again, I know I sound like a broken record on this fragmentation, but all of these things lead to a much more dispersed decision-making and much more dispersed spheres of influence and input for public companies. And then the last maybe couple things that I would hit on, we're also seeing a lot more debate around the states, right? There's been a dialogue around different states of incorporation. We've seen Texas and Nevada coming out, right? And all of this is around the very basics of shareholder democracy as well. Some of the big changes or the differences between these states and Delaware are around these shareholder rights, like the very basics of shareholder democracy that we're here talking about. So I would add that to the list of what's shaping the shareholder democracy. And then, the last thing, and I don't have a crystal ball, if anybody here does, I think it still remains to be seen where SEC Chair Atkins is going to focus. I think that there probably could be more changes there coming out of the SEC that could also further impact both companies and investors.
Okay, I'm impressed you did that in 7 minutes.
Yeah.
Excellent.
I tried to be quick.
Right. All right, so thanks for setting the landscape. John, let's talk a little bit about from the institutional investor perspective. In our practice, I get emails all the time, every time Vanguard comes out with a press release, whether it's about voting choice or your structural separation. And I think often clients don't even understand really what it means, A, and then B, what does it mean for you, for them, in terms of everyday engagement and things like that. So if you could maybe just focus a little bit on a couple of the Vanguard hallmarks and help the audience understand what we're talking about.
Sure. Let me describe what we're doing at what we've done, what we're doing at Vanguard, and the why, and then I can try to give some of the industry context of what I understand from other asset managers, just from public statements. So, Vanguard is known for our index funds, but about 20% of our assets are in equity funds with an active strategy. In 2019, we moved voting responsibility and engagement responsibilities for those active funds to those managers. So a portfolio company that is held by one of those managers, like Wellington or PrimeCap, if you're Microsoft, you've long known that Wellington is a large investor through the Wellington fund that Vanguard manages, but my team does not vote those shares. So those companies are aware of that. That's something that's been going on. That's one of the things that I understand that BlackRock has done is separate out the engagement and voting for their active funds from their passive funds, which just makes the world of sense when you think about what it is to be passive. And that's one, as Krystal mentioned, that's one of the things that's coming into sharp relief over the last couple of years is the regulatory pressure and policymaker interest in defining what is passive. Vanguard is actually I think we're the only active asset manager that actually has a passivity agreement with both the Fed and the FDIC, where we've defined what it means to be passive beyond the 13G guidelines. So we're actually very comfortable with our approach. It's always been what's guided us. It's how we've talked about our approach to investment stewardship and proxy voting for years. What's changed, because we have clients, investors who want to have a voice in how their shares are voted. Legally, for the lawyers in the room, legally the fund owns the portfolio companies. But intuitively, an investor in a mutual fund or an ETF, it's their economics at risk. They feel an ownership, and many of them want to express that through a vote. And so since 2023, we've been piloting a program which we're now bringing to scale across all our US equity funds. We're up to a couple $2 trillion in eligibility, where we allow the end investor to make a policy selection to direct how their pro rata shares are voted. It's the idea behind that, what we call investor choice, there's three kind of core beliefs. One is that investors do have, it's an intuitive right to express their preferences. Two, and we see this in the data now from our pilots, which I can talk about, investors have different perspectives on what is going to maximize shareholder returns from the perspective of corporate governance outcomes. So we've seen a real distribution of what policy selections investors make, which reflects that difference of opinions. And third, importantly for this audience, I firmly believe that actually bringing those voices into the system actually can improve corporate governance outcomes over time. So that's where we are. I think other asset managers, one thing unique about Vanguard is that we serve individuals, whether directly through our platform or through a 401k plan or a 529 plan. There's 50 million individuals we serve. We don't have sovereign wealth funds as clients. We don't serve pension funds. We used to have separately managed accounts that did have some institutional investors overseas, and I still, in a file cabinet, have curly up fax papers, for those of you who remember what those were, where we would get faxed instructions on how to vote, because clients in separately managed accounts have always had the right to vote. And that's what a lot of asset managers are doing, is bringing that back to the front and saying, if you're an institutional owner and you want to vote your holdings, you can go ahead and do that. For us, it's different because it's retail. And so it is, we recognize the complexity that that's going to introduce for portfolio companies. And it's why we're at panels like this and other industry conversations to share what we're learning, so that we can also get feedback from portfolio companies on what's working and what's not.
So I'm a corporate secretary at a public company getting ready to do my off-season engagement with Vanguard. What does this mean for me? What should
Sure,
I
and that's a good reminder, because I missed one important step. You mentioned the separation of voting.
Separation.
That is actually, it's an independent fact, and this is something that other asset managers have done previously. It's a different consideration. It's very much within the asset management space. There are capacity limitations at the state level. So think gaming commissions or insurance, where there's a limit on how much a fund manager can own. These rules were put in place before there was a concept of an index fund. There were things like, what family controls a casino, is my understanding. But the way that you can actually address that from a regulatory perspective and just to streamline operations is by having separate managers. It's a move that T. Rowe Price announced and moved to a couple years ago. Capital Group has a similar structure where they have separate internal investment managers and investment stewardship teams for those managers. Okay. So it's a disaggregation, if you will. So you'll have different human beings making the decisions. Day one, they will start with the exact same policy. Okay. It's literally two parts of my team that on January 1st will split and operate independently. They'll start with the same policy and the same philosophical approach, but over time, different human beings will make different decisions on the margins. So if you're approaching Vanguard today, what you're going to have is in the future you'll have those two separate programs, and you'll know who to talk. One's going to be Vanguard Capital Management. One's Vanguard Portfolio Management. 98% sure I got that right. You'll know who to talk to the same way you know how to talk to today. You will also know that we have investors who have opted into our investor choice program, and one of the things we're doing is providing disclosure of, and what does that look like? What kind of percentages have picked what policies? So that you'll also be able to forecast out and say, okay, I know that blank percent have chosen to vote with management. Mm-hmm. I know blank percent of their investors have chosen to vote according to a third-party ESG policy or a policy that says to kind of vote to abstain. So we're trying to provide the disclosure so the portfolio companies will have as much information as they can about what their investor base looks like.
Right, but what I hear from you is that GCs need to make sure they understand what their investor base looks like and who's holding them. And I think in the past, maybe it hasn't been quite as important as it's going to be now, so thanks for that. Okay, moving to advocacy. Kate, I have heard you say that shareholder democracy is a powerful tool, and would love for you to talk to the audience about what you mean by that and what you think the current environment may mean for shareholder advocacy.
Absolutely. So I think that shareholder advocacy and really shareholder democracy is a powerful tool because it provides companies with a structured and predictable way to engage with their investors. And we can often be a source of insight and accountability. And I think I've seen firsthand how companies can improve their policies and practices when they listen to shareholders and allow space for constructive input. And so just quickly, one example is, I have a colleague who several years ago engaged companies on getting bisphenol S out of receipt paper. It's BPS is basically like BPA's equally bad cousin, essentially. So she filed chemical management proposals and was able to withdraw them and for agreement. And now those companies that were willing to listen about BPS and receipts are ahead of the state regulations that are now coming out. And also, some of them took a more thoughtful approach to developing a chemicals management policy. And I think that positions them well to be ahead of these issues going forward. I think for Trillium, we see ESG risks as material. And I should also say that I forgot this in the intro, but we engage our portfolio companies on ESG topics because we want to increase shareholder value, but we also want to advance humankind towards global sustainable economy, a just society, and a better world. But I think that in a highly deregulated environment where corporations aren't as constrained by the democratic process, it is in the best interest of society to have concerns effectively communicated to corporate directors and management so that they don't lose sight of their social and environmental impacts. And I think that in terms of the current environment, I know we'll talk a lot about that later as well, but just briefly, I think that dismantling shareholder democracy doesn't help directors or companies. It reduces transparency, and it makes it harder to resolve differences in a fair and efficient, orderly way.
Yumi, following up on that, do you have thoughts about the impact you think a more fragmented and bespoke kind of approach may have on coordinated shareholder campaigns? A lot of what the New York City Comptroller does.
Yeah, well, thank you for inviting me. I talked at CII in early September, and on the panel I said, nothing has happened that's going well for investors. And then other things happened. So we have now Exxon retail voting platform, we have bespoke guidelines, we have maybe the death of precatory proposals in Delaware, so I should stop saying that. Everything's going great for investors. I think so for New York City, because we're a small institutional investor, we're not affected by the 13D, 13G guidance in terms of being able to collaborate, but I think the challenge here is, and I know at this conference we've talked a lot about deregulation or re-regulation. The challenge in everything becoming fragmented is that all of us have to expend a lot more energy and resource in trying to sort of coordinate everything. So for example, the upside could be that all of you want to talk to the smaller institutional investors as well as the large ones, because there's certain restrictions potentially with them, and so they can come knocking on our door. I think the challenge could be when we have our own initiatives, whether it be a vote no campaign or a shareholder proposal, then we have to reach out to so many more people, than we used to. So there's sort of an upside to it. There's a downside to it. I do think that, generally speaking, this time is very fraught. And, I think the panels have really talked about volatility and trying to be stable and consistent, and we are all for that as well. So backing up Kate's sort of statements around transparency, it's things like engagement with many of your institutional investors, engagement around shareholder proposals, which is a really important tool for smaller institutional investors to put at your feet, and try to get sort of a come to the table compromise and negotiation around that. I think losing things like that would really detrimentally affect the ecosystem. And just putting out there on my soapbox that trying to get rid of a non-binding shareholder proposal that could potentially allow you to gauge investor sentiment in certain things, the potential backlash against that, and also you would have to think, what else are we going to get up to if we don't have that? Is it going to be a director vote no campaign? Is it going to be universal proxy cards to be used for shareholder proposals without limits on words or number of proposals? So I just want all of us, when we're thinking about consistency, transparency, and stability, to prioritize what you're going to focus on and what the downside might be.
Kate, what are your thoughts about the potential elimination of precatory shareholder proposals, and does it affect your advocacy strategy? Isn't this a great thing for companies?
As you may guess, I don't think it is a great thing for companies. But I think ultimately, like Yumi was saying, these proposals are non-binding. They're advisory. They're a communication tool. They're a way for companies to gauge shareholder sentiment and engage with diverse investor perspectives. And I think that removing them would really strip away a key mechanism for resolving differences, constructively and transparently. And also that without clear rules of the road, we risk entering into a chaotic environment where actors are, behaving unpredictably, where there are unintended consequences, where communication is less efficient. And I think we saw that in February with 13D and 13G. And there are already rumors now that with the SEC staff furloughs that some activist investors are pushing the boundaries, because no one's watching the shop, and that's not good for anybody. And I think shareholder proposals aren't perfect. I'm not trying to pretend that they are, but they are a reasonable and time-tested framework for resolving conflict and fostering accountability. And I think if these structures fall apart, that companies lose the benefits as well. That introduces unpredictability, and it could lead to more aggressive tactics. I think that shareholder proposals are a structured way to raise concerns before things get to that point. But I think that we could see more creative vote no campaigns on auditors, for executive compensation, on committee chairs, because investors will find other ways to be heard. So I just think it's in everyone's interest to preserve fair and democratic and transparent processes. And then also just a point on legality. So I think I am certainly not an attorney, but it is my understanding that Delaware courts have acknowledged shareholder proposals, for decades, going back to at least the 1980s. So to suddenly suggest that shareholder proposals don't have a place in Delaware law would appear to fly in the face of common practice. And I also think that in terms of precatory proposals, there's in company bylaws and in proxy statements there are clauses that allow for shareholders to bring proposals that don't appear in the proxy statement, but that are brought and voted on at the annual meeting. So I think there's all different kinds of things that could happen, and I think in some ways we don't I don't think it's in our best interest to go there.
I think companies are often, and having sat in that seat, very focused on the resource allocation and the time spent on shareholder proposals. But what I'm hearing from you is that you're not sure that actually will be eliminated. It'll just be transferred to some other activities.
Exactly.
One thing, if I can jump in on that, actually, one of the things that we saw kind of the flip of this years ago before Dodd-Frank and the say on pay vote, right? When the say on pay vote came into existence and investors had an ability to vote on pay, director votes went up because the pay vote actually served as, frankly, a release valve, a way for investors to convey a message without having to vote against a director. And so I would agree. I feel like this is something, if you look back, like we have gone through this cycle, and I actually think there's something to learn in terms of looking at the impact of when these different mechanisms have been either deployed or pulled back, and the other impact they've had.
What about thoughts about the latest announcement from Glass Lewis that it's going to discontinue its universal benchmark voting recommendations? What are the implications there for proxy dynamics, campaigns, shareholder proposals, those kinds of things? How should we be thinking about that? Yumi, Kate, anyone? John?
I think it's a terrible business strategy for Glass Lewis. I know a lot of people who work there. I think this is all affects, basically what we're seeing is regulatory scrutiny is creating some fragmentation within our ecosystem, and the proxy advisory firms are not, have not escaped that as well. So the strength of them should be that they're pooling all the institutional investor clients and creating a benchmark view. But now there'll be multiple views depending on how you'd like to read the benchmark report. However, most clients have their own custom policy, so it's a little bit like maybe it skirts certain scrutiny, but then they would have to say, our clients who care about this thing would follow this policy. Our clients care about this thing, follow this policy. And I just don't think that's a very efficient way of managing the process. I'm sorry, the question was, does it affect how we do business?
Well, yeah, how do you think it'll affect you?
I think we do engage them when we talk about a director vote no campaign or shareholder proposal, and we'll get like 4 different answers. So we'll be in the same seat as all of you when we talk to institutional investors, and there's 4 different house views, at an asset manager. So in that sense, maybe we'll be in the same boat, but I don't think it's an effective or efficient strategy for them.
If I can offer maybe a slightly different perspective, which is companies have had concerns about the concentration of power, whether that was concentration of power with an asset manager or with the proxy advisory firms. This is a actual reflection of what the actual law and market is, which is the underlying client has a responsibility to vote. I actually think, I'd probably politely disagree. I think it's what I would have done if I was Glass Lewis or ISS from the beginning. Say, I don't have a benchmark, I have research. I pass that research through to the underlying client. That client makes a decision on how they want to vote. It's again, it's a little bit of a careful what you wish for. I think that the desire to have a disaggregation, this is disaggregation. There's now thousands of different individuals that are going to have custom policies that I'm a market believer, we're index funds. We believe the market's working over time and being efficient. I actually think a market will evolve where there will be clarity on kind of where are individual investors, in the case of investor choice, where individual investors coalescing, where are institutional investors coalescing in terms of their general beliefs. So my recommendation to portfolio companies is something I've been saying for years about investor choice, which is there's even more of a premium on portfolio companies providing clarity in their disclosures about what they actually believe. So in years past, there's like, well, why do you need to engage? Because you need to engage to get more color from the company on something. If the company would, you'd read a proxy statement and it would appear like you'd read the whole thing and you'd be like, this all sounds like they agree with the shareholder proposal, but they're recommending against it. Why? I think there has to be clarity. If you think a proposal is not in the interest of shareholders, you have to actually really explain why. And I think that's something that's going to come through in a world where it's much more disaggregated.
That's right. I think the biggest takeaway from the current environment, is that engagement, disclosure are a strategic exercise and are going to demand a lot of thought on the front end. And I think disclosure is going to really emerge as something that's super important. So we're almost at time, but if you could recommend one strategic action for a company or a board to take as they're thinking about this kind of shifting center of ownership, what would that be? Krystal, you want to start?
Yeah, sure. Look, it goes with everything we've been talking about, but I actually think even as companies are preparing to go out and talk to your investor bases, the differences in investors are only widening. And so I think about, a lot of the work that we do to prepare companies. They're going out to get ready to talk to investors, and there's probably more differences than there are similarities now. And so I think the amount of time focused on, I'm going to go talk to John. What are his priorities? What am I trying to get out of this conversation? When I go talk to the other John at BlackRock, what am I trying to get out of this? It's actually very different as opposed to I want to go share our narrative with all investors. It's actually that you're having a very different conversation, I think, is one of the things we're seeing. And so my advice would be prepare for those very different conversations.
Yumi?
Yeah, I guess in terms of hearing a lot of institutional investor voices and bringing up the retail voice as well, I would think twice about instituting a pro-management robo-voting platform in perpetuity. I'm not going to name any names, but just big red flag there.
John?
I kind of gave mine that I think the providing the level of disclosure that allows systems to work is going to be really important.
Yeah. Kate?
I think I would encourage companies to advocate on behalf of the preservation of these rules that are reasonable and allow for efficiency. Because I think even if the current system isn't perfect, we may not like what comes next, and could be more aggressive. But if proposals do go away, I think it's in companies' best interest to continue speaking with many different types of investors, because it's a way to broaden viewpoints, but also because shareholders who may have voted for a proposal may now feel that they have to vote against a director. And I think that it's even if you don't fully agree with what an investor is saying, listening doesn't mean conceding, and you're just staying informed and keeping ahead of the curve.
Yeah, and I think my advice would be, I think companies need to make sure that this area is resourced, right? We have a lot of clients who don't have anyone who owns shareholder engagement outside of maybe someone in IR. And I think it's really important to make sure that you've got someone to help you prep for the meetings, do that research. Who am I talking to? What funds hold us? What matters to them? Are there structural changes? All of these things, I think, need to be managed and are going to involve resources, whether it's internally or externally, but just make sure you're thinking about that as you move forward. And with that, Anjali, thanks.